Today, my guest is David Rosenberg of Rosenberg Research, and we talk about the biggest elephant in the room that seemingly nobody is paying attention to from David's perspective. He says this is why we go risk off. And we get into that event today, why nobody's covering it, and why he is so concerned about the biggest risk in the global marketplace today. We talk about portfolio allocation. He likes cash. He likes gold. He likes gold miners. We talked about that. If you're curious about how to build a portfolio in the gold or silver equity space, check out the Commodity University. This is a catalog of courses taught by some of the best investors in the precious metals business, and new courses released every single month, thecommodityuniversity.com. Here is David Rosenberg of Rosenberg Research. Enjoy.
This is Jay Martin.
Okay, here I am with David Rosenberg. David, it's great to have you back on the program again. I appreciate you making the time.
Thanks a lot, Jay. It's great to be back.
Okay, so there's many different directions I want to go within the hour here, but here's where I'll start. I want to get your thoughts on Doge. I want to start with Doge. And as I watch the initial headlines, all the momentum, the hype behind the things they might do or were going to do in terms of efficiency of government spending, and what I've noticed to be a very significant decrease in volume over the last month, right? A lot less headlines, a lot fewer headlines, and decreased momentum. And I was reflecting on the David Stockman book, The Triumph of Politics: Why the Reagan Revolution Failed, meaning Reagan got to power with all these promises of efficiency. Within 6 months, a lot of that was seemingly vanished from his party. What's the impact of Doge from your perspective? Is there any? And if so, what would you point to?
Well, I think a lot of it was to really blaze the trail for what we actually saw in the big, beautiful bill that barely made it out of the House and into the Senate, which was getting the public acclimatized to the view that we were going to be seeing significant spending restraint. So there's no doubt that Elon Musk hit a bit of a wall. Now he's going back to spend more time where he probably should on his own companies, and especially Tesla. But a lot of this, as you know, with Donald Trump, was more psychological in nature than anything else. I mean, when I was first looking at Doge and what sort of fraud and waste and abuse you can really cut out of the budget, it was never going to amount to $2 trillion. That was just a nice number, like throwing spaghetti against the wall to see what sticks. But a lot of it was really to pave the way for what we saw in this budget bill, which people seem to think has a lot of stimulus. But there's actually is a ton of restraint on the spending side, especially as it pertains to Medicaid, which contains a whole bunch of goodies, and also some other areas of government spending. So what it did was actually lead the way towards a budget package, which you could argue has tax relief in it, and I'm sure we can discuss that. But it paved the way for significant spending restraint, which is what we're going to be seeing in real time. In fact, I would expect that once this big, beautiful bill gets through the Senate, there's going to be more spending restraint than what's being advertised right now.
Then do you think the big, beautiful bill is being misunderstood by many in the media, or maybe by historic Trump supporters who feel that it isn't enough restraint and they expected bigger cuts to spending, not necessarily taxes, but to spending?
Well, last I saw or counted, there were at least 5 senators on the Republican side that expressed that exact view, and of course, including Rand Paul, who is dead set against raising the debt limit as much as what was being proposed in the House bill. So the answer to your question is correct. I think that the big misperception, as I said before, is this view that there is a lot of stimulus in this budget bill, and there really isn't. You know, when people talk about, well, you know, that we're going to be tacking on $3 trillion additionally to the debt over the course of the next decade because of this budget bill, all of that and then some, like $4 trillion of that $3 trillion, is just from extending the 2017 tax relief package. So just to maintain the status quo and not fall off the fiscal cliff at the end of the year means that you're going to be tacking on $4 trillion. I think that what is being missed in the market, what's being missed in the media, is that when you tack on the actual net new tax provisions and the net new spending restraint, and then, of course, a lot of that future deficit increase is because of the fact that the Fed is keeping interest rates pinned at a more elevated level. So you have $500 billion plus of incremental debt service costs. Well, that doesn't go into helping out the economy. That's interest charges on the debt. Actually, when you take out your pen and paper, you do the arithmetic, this big, beautiful budget bill will actually drain real GDP by 0.5% per year, 0.5% on a $30 trillion beast, otherwise known as US GDP. That is not chump change. So what's being missed is that when people talk about, well, look at all the stimulus, well, they're including in the stimulus the extension of the 2017 tax cuts, which were supposed to expire at the end of this year. That's not real stimulus. That's basically, when you look at it benchmarked against the status quo, there is no stimulus in this budget. There's actually fiscal drain. And if they allowed the tax cuts of 2017 to expire, and maybe they should. I mean, there was a sunset clause put in there for a reason. Of course, a lot of that was to get the CBO budget scoring so that it could get passed. But, it's just the same thing with government. Things have a sunset clause, and the next thing you know, they're made permanent. So that's my message, really, is that if they let the tax cuts expire, mostly on the personal side, you'd have had an annualized drain on GDP of, say, closer to 2% than 0.5%. But either way, no matter you slice or dice it, this is a fiscal package that should lead you to be reducing your long-term economic growth projections.
Okay, I want to pull on that. And just to expand on something you said, extending the 2017 tax cuts, would be an extension of a tax cut from back then. But today it would just feel like a significant tax increase if those cuts were not extended. And that would be relative political suicide for the Trump administration. If they were to not extend those cuts, what people experience is therefore a massive tax increase heading into the midterms, pretty unpalatable. Is that do you agree with that?
That's right. It's budget. It's stimulus only if you were taking the number off of what was to expire. But really, what you have to do is look at the budget bill benchmarked against the actual status quo, the actual here and now. To me, it's more that you avert falling off the fiscal cliff, more than adding stimulus to the economy. People have underestimated how deep the spending restraint is in this budget. And of course, you can't really count in incremental debt service charges. Of course, that adds to the debt, adds to the deficit, but doesn't add to the marginal utility of economic growth. So you have to take a look at program spending, the net tax reduction, and it comes out, as I said before, towards taking real GDP growth, whatever baseline you have. And of course, we don't know what's going to happen in the Senate. But what I'm hearing from the Senate is that there is going to be more cuts on the spending side. So when I say that this is a net drain of 0.5% per year for the next decade, I'm amazed that nobody else has anything that talks about that number. Everybody thinks this is stimulative. The stock market certainly thinks it's stimulative. It's not. I think that there's a real misleading narrative out there right now.
Yeah, there certainly seems to be. Okay, so thank you for that. So yeah, real drain on real GDP by 0.5% per year, $30 trillion GDP. It's like $150 billion. The takeaway from this should be that if you haven't reduced your long-term growth prospects, you probably should. Where are the significant vulnerabilities or weak points, David, when you think about long-term growth prospects being reduced?
Well, I mean, I'm not so sure how to answer that question, except to say that um, a good chunk of the economic expansion that we've had, which people called American exceptionalism, and of course, I think that the inflection point in the technology curve that you could say started in the fall of 2022 with ChatGPT and NVIDIA and so on and so forth. But then we're seeing China has played some serious catch up on that score. But the American exceptionalism was really, the Biden chip subsidies, the oxymoronic Inflation Reduction Act that had so many tax expenditures and other subsidies and spending. Most of the growth that we had in this economy in the past 5 years came from the government sector, directly and indirectly. Not to mention $2 trillion of stimulus checks that kept the Energizer Bunny going right up until last year. So when I'm taking a look at the economy, we're going to be seeing some significant fiscal policy withdrawal. I think that's radically underestimated. And then for better or for worse, I'm not going to sit here and debate whether we should get rid of abuse, waste, and fraud in the government spending. I mean, who doesn't want that? And who doesn't want better border controls and maybe a more sane immigration policy? However, there's economic effects. So even when you look at, for example, tighter immigration rules, well, there you have up to another 0.4% per year of drag on GDP because people make up GDP, whether they're native born or whether they're immigrants. People make up GDP. Well, that's going to be 0.4. And if you remember, one of the reasons why the Fed had been raising its estimate for R star, or the natural rate of interest, was because of the very dynamic demographic developments taking place over the past few years. For better or for worse, I'm not going to get into social policy out of this or play politics on immigration, except to say that that movie, like fiscal policy, is now winding in the opposite direction. You had a whole bunch of other goodies out there. What about student debt relief? Student debt relief. Well, that just officially ended. You could argue not a big deal, but that's, call it 0.1%. All of a sudden, the freebie is over for the student sector. They tend to spend most, if not all, of their income. So you add all this up, student debt moratorium over, immigration rules being tightened, the shift from fiscal stimulus to what is net fiscal drag. Well, just from those alone, you just lopped off a percentage point off your baseline GDP growth. Well, where's baseline GDP growth right now? I speak to most people, they still think it's 3 or 4%. I cannot begin to tell you, Jay, how many people still have their heads either in the sand or wrapped into the memory of the past few years. No, the run rate on real GDP growth right now is down to 2. And now we just had policy shifts. We haven't even talked about the tariffs yet and all the uncertainty around that. But just in terms of student debt, immigration, fiscal, right there, you've lopped 100 basis points off your baseline GDP growth. So you've gone from going from 2 to 1.
Wow.
Just from that alone. And if you're going to take aggregate demand down by that much, you are going to have an increase in the employment rate. You're going to have more economic slack. And all the concerns about inflation are going to prove to be misplaced. So that's where I'm coming at it. Even though we haven't even mentioned tariff, trade, reprieve, deal, telephone calls, on and off policy. We haven't talked about the effects of that yet. Everything else that I've just been discussing have been headwinds. The only tailwind that I could think of are data centers. Okay, that the AI revolution is real, and that's providing an offset to be sure. But you know what? The advent and proliferation of the internet, back in the late 1990s, that was a massive productivity shift in the economy. And even as society benefited from it ongoingly, and that never stopped, we did have a horrible recession in 2021, in 2001, and then hardly any recovery for the next 2 years. The recovery really started in 2023, 2024. And it was Iraq War II that helped us get out of the torpor at that particular point in time. So, and then you got to count on the fact that the rest of the world is pretty well flat in its back. I guess that we could say, well, but look at Germany. They're loosening the fiscal rules, and it's going to have a big impact on Europe. Yeah, but they're going to be spending money on defense, and it's going to be for their defense contractors. Europeans are going to benefit from that. That's going to be homegrown growth that will certainly benefit Europe, but I don't think there'll be much spin-off into the United States. But outside of that, the rest of the world, and especially with the tariff and trade shock, the rest of the world is going to be fundamentally weak. So you're not going to get a big shift into the export sector in the United States from this. And the export sector might not be a big share of the economy, but it has huge multiplier impacts, huge indirect impacts on the economy. And then we get into what else is happening. It's very interesting to me that, apparently we're going to have a 30% tariff here, 145% tariff there. Then we get a phone call, whether it's China, the EU. Your head just spinning on all these changes that are taking place. But what's interesting to me, and this comes down again to the economic outlook for the United States, is that people around the world are taking matters in their own hand. So you might have the president of the EU, cap in hand, going to the White House. You could even argue that it was Xi Jinping that made the call. You certainly know that Keir Starmer over in the UK is doing everything he can to cozy up to the president. Japan, the same sort of thing. But the populations of these countries, and I live in Canada, and I can tell you that you can't go into a store and not see the Buy Canada signs everywhere. And people are deliberately not buying American products. This is happening here and it's happening abroad. So even as these governments kowtow to the administration, the residents of these countries that make up GDP, politicians signing agreements or deals or whatever, they don't make up GDP. The people do. And so you're seeing this, and it's been reflected in the US dollar. People are boycotting as best they can U.S. products. You are seeing U.S. exports sitting on the shelves at the department stores and at the grocery chains. So those strawberries from California, when you go shop at Pusateri's on Avenue Road, they're going rotten. And all this could have been avoided, and it's actually quite sad. But the biggest impact is on travel and tourism. And Oxford Economics just put out a study saying that foreign travel and tourism into the United States is going to be going down 9% this year. And when you're taking a look at the economic reopening post-COVID and what drove the economy, what drove the labor market before ChatGPT was travel and tourism. It was the hospitality industry. It was going gangbusters, and that is a very labor-intensive industry. It's a huge employer. You're talking about the hospitality industry and all its spin-offs supports 20 million jobs in the United States and touches $2 trillion of GDP.
Wow.
And people are deciding, and certainly you got to be seeing that too. You are seeing what WestJet, Air Canada, other airlines, they're canceling flights and reducing their frequency of trips into the US. And it's not just from Canada, but it's from Europe.
Yeah.
So, when you start tacking that on, and we'll see it. we'll see it because we're heading into the summer season. We're heading into the part of the year where travel and tourism is expected to really boom seasonally in the United States. I think that is going to be a big disappointment because travelers are either choosing other destinations or they're just staying at home.
The smartest investors know that real wins come from thinking independently and spotting opportunities long before the crowd. And that's what we teach at the Commodity University.
You know, a few things in there, just summarizing the big, beautiful bill impact on GDP at 0.5% year over year. And then you touched on the ceasing of the student debt relief programs, tightening up immigration policy. Collectively there's, you know, a percent of GDP layered onto a real growth rate of 2%. That's then halved. That's the real impact of a lot of this restraint and cuts, which is significant to cut the GDP growth rate in half from 2 to presumably 1 if all this materializes. Then you tackle something like travel, and you're right, I'm based in Canada as well. I've seen the major airlines reroute a ton of flights from major American airports to Europe. Demand's definitely down, and I just hear it in conversations, you know, on the sidewalk, as you mentioned, walking into stores and seeing Buy Canada slogans everywhere. How much of that do you think is long-term? And I guess the question comes from a place of, you know, we've been watching this on again, off again tariff ping pong, as you mentioned. A threat's made, a phone call's made, something's reversed, all this back and forth. But the populations are changing their habits. Is that a short-term trend, a long-term trend, or what do you think are the most impactful long-term impacts of this trade aggression and tariff ping pong?
Well, look, I've been around long enough to know that nothing is permanent. But this is a rupture that's going to be difficult to contain, let alone reverse. Donald Trump just took office in January. You know, we're in May, about to head into June. He's got another 3.5 years. You know, Congress traditionally had control over trade policy. They relinquished that to the White House. And let's face it, people are scared of Donald Trump. It would take a monumental decline in his approval rating to get even the Freedom Caucus in the House to stand up and pay attention. So it's hard to say, you know, long term, what's going to be in 10 years or 20 years. I mean, who knows? But let's just say what we do know, that this president, who, although likes to do deals in America's interests, is very isolationist and doesn't really treat his friends, but really as business partners. But business partners to make America great again. Not necessarily to make Canada great again, or make Europe great again, or make Asia great again, but to make America great again. So I would say that let's take it a year at a time. I think that if we take it a year at a time, let's have this conversation about whether we can repair the damage after the elections in 2028. But outside of that, what you see is what you get. Yeah. And there will be the law. There will be the law of unintended consequences coming from all of this.
Sure.
Canada, unfortunately, is sort of caught in a box because we can't really reroute our trade. We could do more trade with other countries, but the proximity to the U.S. market, you know, we are stuck with the U.S. as our major trading partner. That might be permanent. I don't see that changing. I don't see how it could change. No. But the rest of the world will turn into their own trading blocks. And that's, I think, where you're going to be seeing. And the U.S. will become more isolationist. And maybe for the administration, this is what Donald Trump wants all along. He does not want to be reliant on foreign production. He wouldn't mind if the foreign production set up shop in the United States. I think that that's probably not going to happen. And I think a lot of the numbers being bandied around are just smoke and mirrors. But that is the hope. You build a tariff wall in the hope that foreign producers come and set up shop in the home country. But then again, that's a long-term, multi-year, if not multi-decade decision companies are going to take. And if they figure that the U.S. political cycle is such, now maybe this is Trump 1.0 and he had 8 years left, well, then you have a decision to make. But I think that the likelihood is that companies around the world, the multinationals, are probably going to try and wait it out. But in the interim, you got this trade war with China that's not a new war, but it's a war that's entering into a new chapter, and a war in terms of who is going to pry who from who. Who will China pry away from to extend its trading relationships? How will the United States try and resist other countries from doing more business with China? These are the future chapters that are going to be written, with very important, of course, geopolitical risks as well. But the world, in some sense, is going to get smaller, and you're going to find that there will be more regional trading blocks taking place as a response to the U.S. becoming more protectionist and isolationist.
The world will get smaller and more regional trading blocks will emerge because countries not like Canada. I mean, Canada, as you mentioned, is unique. We share the largest land border in the world with the world's hungriest and wealthiest consumers. So it's a great trading partner. And yes, very tough to beat the economics of just falling across the land border when you consider instead shipping to Europe or Asia.
Easier to have trucks ship your goods to the U.S.
Always.
Since you can't really do it across the Atlantic.
Yeah, you're never going to beat those economics. Agreed. The regional trading blocks will be an option for most other countries, though, and so that's interesting. So you're seeing blocks emerge like the ASEAN countries or European blocks, just removing trade restrictions among neighboring countries to increase cross-border business in their regions. This is what you're referring to?
Yeah, look, it's look what happened on Liberation Day, April the 2nd. I guess it was an attempt to liberate us from our sanity. And there, Donald Trump is there telling us that Xi Jinping is going to pick up the phone at any second. And instead, Xi Jinping got on a plane and did a week-long junket through Southeast Asia. Mm-hmm. I think you're going to find that... the question for China, and that's the elephant in the room, is can China, does China have the capacity and the willingness to shift its economic model towards consumerism and away from its export dependency? Now, it's less export dependent than it has been in the past. 20% of its GDP are exports. That's down by about half from where it was a couple of decades ago. And its reliance on the U.S. has actually gone down. The U.S. will not bring China down to its knees. So for China, the choice is to shift towards a more consumer model, get those exorbitant savings rates down. You don't have to go into massive consumerism with gobs of debt like the United States has, but certainly make it a more consumer-oriented economy. Can that be done? Will it be done? These are question marks. I'm surprised that it hasn't been accomplished yet. But the one thing that you cannot underestimate China is its ability to cobble together relationships in other parts of the world. The massive investments it's made in Africa over the years. It's increasing ties in South America, Europe, and of course the rest of Asia. And I don't think that the United States, I don't think Donald Trump will be able to break those links. And in fact, the risk for America is that those links with China and the rest of the world are going to increase, not decrease. I think it's folly to believe that we're going to come out of this with China's share of global exports going down. It's probably going to go up.
Interesting.
And the U.S. will become increasingly isolated. Like we say all this is still early days yet. I mean, reciprocal Liberation Day, that was April 2nd. Where are the early innings here? And we don't know. We just know how the markets are like Pavlov's dog. They'll risk-on assets sell off dramatically on a tariff increase, and then a day later or over the weekend, there's a telephone call and a deal, and the markets rallied. It's like a massive roller coaster ride. But we are going to come out of this with higher baseline tariffs, at least 10%, and probably more than that for China. And so that isn't the worst case scenario. The worst case scenario is what we saw April 2nd. But this hasn't fully played out yet. I think that when you're taking a look at the markets, you're going to say to me, how are the markets responding the way they're responding? How is this possible? Because the markets are making an assumption. Then it's up to me and you, Jay, is to say to our clients, well, do we agree or not agree with the assumption? The assumption is that Trump is changing his mind so much that his behavior, the pattern of behavior is such that investors now believe that he's not going to carry through with the tariffs. He's going to continue to kick the can down the road as long as he can. And that's been the pattern. And that's the prevailing view. But then you have to ask yourself the question, at what point do you start to lose your credibility? Like the question is, say from a geopolitical standpoint, is Vladimir Putin, is he watching this pattern of behavior on the trade side? That Trump is willing to say one thing and threaten and then pull back. Threaten, pull back. So if you're an aggressor, and Putin's obviously an aggressor, so look how this plays out in the global field. At what point you can only play this game of threat, reprieve, threat, got a deal on the phone. You can only play this game for so long. It does have an expiry date. And then your credibility starts to erode. And then that leads to a whole bunch of other problems when you have a president who loses credibility as to what actually ends up getting done on the legislative side.
Yeah, and it's tough. It would be tough to do any kind of a deal with the United States, knowing maybe as volatile as this administration is, but even lacking that, you're dealing with a new leader in 3 years anyways, and if history is any precedent, then that new leader typically is ideologically opposite from the previous. I mean, that's generally how Americans vote. And
yeah, it depends if J.D. Vance becomes the next president. Then you're going to have, the equivalent of a younger version of Donald Trump in office. So
right,
but we don't know. What's interesting is that he's the vice president. Normally, well, I shouldn't say normally. It's not as if Joe Biden got any support from Barack Obama, who supported Hillary Clinton. But normally, the vice president is there, sort of the heir apparent. But the fact he hasn't endorsed, and maybe it's just too early. But it's hard to say what sort of who's going to win the next election, who's going to be running for the Democrats. Could the Democrats clean up their act? But the good thing about the midterms, which are next year, is that's a real check and balance. That'll give us a greater pulse as what we can expect in 2028. We will get when you're taking a look, for example, at the 2018 midterms, gave you a taste that maybe Trump 1.0 won't be followed by Trump 2.0, at least not right away. That's exactly what happened. So at least we'll have the midterms next year. That's the beauty of the U.S. political system is that check and balance, that it isn't an election every 4 years. It really is an election every 2 years, and the midterms are usually a very important litmus test.
Yeah, in terms of being too early to endorse Vance, I think Trump is still at this point saying he's seeking legal grounds to find a third term, and we'll have to wait and see what comes of that.
Yeah, it's interesting that he could run for a third term if there is a crisis. Mm-hmm. If there is a crisis. And so you start wondering about, what was that movie back in the 90s with Dustin Hoffman and I think it was Robert De Niro. It was called Wag the Dog. Do you remember that movie?
Yeah, all right.
Remember that movie? All the viewers should watch that movie. We may end up living through a Wag the Dog, sort of a manufactured crisis.
Sure.
To get that third. Well, I don't think you could rule it out. I just don't know what that crisis is going to look like. But you do have a president. How did he manage to get all these tariffs through anyways? how was he able to even abrogate the USMCA with Canada and Mexico was because of this arcane law that gives him the power to establish tariffs, take over trade for, quotes, national security reasons, which Congress bestowed on the president back in 1962 to Kennedy to fight the Cold War.
Really?
So I'll just say, Donald Trump is a real estate mogul. He's not a lawyer, but you know as well as I do, he spent most of his life with lawyers. And he doesn't always win in these court cases. But he knows what the laws are, that's for sure.
Yeah.
And he knows which provisions can be bypassed.
Sure.
So when you talk about a third term, if you're going to make any side bets at the cocktail party, you might make a lot of money because it is certainly not out of the realm of possibilities.
Yeah, no doubt. And, I guess I considered the crisis scenario, but I also found myself thinking if you were going to make a case for why a third term should be allowed, if it were me, and I'm not saying this is what I want to see happen, but I would say to begin, just let's make the argument that term limits are by definition anti-democratic, because if the people want to keep the same leader for 12 years, shouldn't they be allowed to vote that person in? And if they're so terrible, just run somebody else and beat them. Like, that's democracy. You run the better candidate and beat the worse one. And like FDR won 4 elections. Term limits are relatively new, right? 1947. So it's like the 23rd Amendment, not the second or the third or the fourth. It's like quite far down the line. So when he said, I'm seeking legal grounds, I looked into it and I was like, I bet you he's going to find them. I bet you he'll find legal grounds to make a case. Whether or not it occurs, anybody's bet. Look, I want to also ask you about the Moody's downgrade. So last week, Moody's downgraded the United States credit rating from AAA to AA+. I've heard 2 schools of thought on this, David. I'd love to get your perspective. One would be, it's actually not a big deal. They're the third of 3 credit ratings to do that. They're late to the party. Fitch downgraded a couple of years ago. S&P downgraded in like 2011. And so the US was already split rated AA+, and Moody's is just late to the party. The other school of thought that I've heard is that, no, this is impactful because Moody's was the last agency holding on to AAA. And there are a lot of funds that can no longer buy US government debt because they have covenants that say they can't invest sub AAA bond ratings. And so with nobody left holding the AAA up, it actually dries up a bit of capital available for government bonds. Either of those 2 schools of thought resonate or something completely unmentioned, David, but what's your take on the Moody's downgrade?
Well, I don't, I'm not so sure I agree with the fact that funds have mandates that they can only own AAA. Boy, that would be a real thin slice of what you can own globally. I think that the highest tranches on those mandates is AA and AAA. So from that standpoint, I'm not worried about it. It's symbolic. It is symbolic. It's a bit of a black eye that the world's reserve currency would not have a AAA amongst any of the 3 major agencies, and I would tend to agree with you. That's more psychological than it is real. It doesn't have a fund flow impact. It's just a reminder that the U.S. is on a slippery slope. It really is, and I was surprised actually that it took them as long as it did, because I think S&P went in 2011, and then Fitch went a couple of years ago. I'm surprised that it took this long, and I'll tell you why. It's because when you look at the U.S. deficit to GDP ratio and the U.S. debt to GDP ratio, the balance sheet of the United States, the balance sheet and the income statement, the U.S. is the weakest of all countries rated AA in the world.
Of all countries rated AA.
All countries rated AA, the U.S. is at the bottom of the list when it comes to their deficit and debt ratios. They are the worst. something else to consider, that the United States has the same deficit and debt ratio as, say, China and Egypt. And China is single A, and Egypt is like double B. So, the ratings are the ratings, but I think it's more down the line is that are we stopping at double A? Now, if you're going to tell me, because what I'm saying to you is that it's not even a double A balance sheet. It's the weakest double A. The United States is the weakest double A in the world. The big surprise is what took so long. Maybe part of it is political. Maybe the United States having the largest army, the largest navy, the Constitution, property rights, rule of law, the world's most powerful and wealthiest country gives it a longer lifeline than anybody else. That much is true. However, numbers are numbers, dollars are dollars, balance sheets are balance sheets, income statements are income statements, and the U.S., out of all AA rated countries, is at the bottom of the list in terms of financial strength. That's something to consider. If you're going to tell me, boy, are we going from AA to AA minus, then the single A, well, then you crowd out a lot of the world's institutional investors with the mandates you're talking about. So it's a slippery slope.
Okay, that's good perspective, because when I read that, then I went and looked like what are the AAA rated countries today, and there's about 11 of them, and some of them didn't surprise me, like Switzerland, Singapore, Norway, but there's some, Canada is on that list, Germany's on that list, the two, I believe, slowest growing economies in the G7 since 2020. From an economic growth standpoint, you could say they don't look very good, but as you mentioned, from a debt to GDP or deficit to GDP, which is what these ratings are based on. My question, I guess, was, would you expect any capital to be reallocated away from U.S. government debt to other sovereign bonds somewhere else?
I think that, I don't even know if it's just bonds. Foreign investors, people talk about bonds. So foreign investors own $9 trillion of treasuries, but they own $5 trillion of corporate bonds. And corporate bonds are priced off of treasuries, so they're joined at the hip. And another, call it almost $20 trillion of equities that foreign investors own, by the way, including China and Japan. Boy, if they really want to play hardball, you wouldn't play hardball in the bond market. You'd play hardball in screwing up people's 401k plans.
Right.
Because $20 trillion so that's what foreigners own of U.S. equities. That, of course, is the flip side of all these trade deficits or the current account surpluses the U.S. has racked up. Current account surpluses means that investors invest in your home country. They drive down the cost of capital to your benefit and increase the rate of return on assets to your benefit. And that's why the United States is so wealthy. And of course, there's a symbiotic relationship between the current account, the capital account, and the current account. In terms of the reallocation of capital, I think that you're probably already starting to see signs of that. You're seeing signs of that because, as they say, the truth is always in the price. And is there a more important price in the world than the US dollar, the benchmark? I guess maybe we'll say now gold is the benchmark, but let's say the US dollar down 8% in short order in something that is normally stable. An 8% decline in the dollar is like a 20% plus decline in the stock market, risk for reward. It's not normal. It's only happened a handful of times. The US dollar, and what really makes no sense, that we have to figure out, is that usually the country imposing the tariffs is the country that sees its currency go up.
Right.
The Fed is the only central bank in the world not cutting interest rates. The latest was the Bank of New Zealand, which was just overnight. The Bank of Canada skipped a meeting after cutting rates, 100 and 75 basis points or something like that, or more. The Fed is on hold. Everybody's cutting rates, and the U.S. dollar should be screaming higher, and it's going down. They're raising the tariffs. Dollar's going down. Not textbook stuff. So you're seeing some of that reallocation already because the U.S. dollar is telling you that. I guess you could say, well, but look what Treasury yields have done. But yields have backed up globally. I don't know. People look at the 10-year note. Look at the 10-year note. Look at the JGB. Look at the gilts. Yields have backed up. It's hard to say, actually, whether it was started in the U.S., was it started with all the tariff uncertainty and the term premium? Was it started with the credit downgrade? Well, that was very recent. Or maybe it started out of Japan. Okay? You want to see a country with a huge debt ratio? It's 200% in Japan. Mm-hmm. Like it's about double what it is in the United States. And here you have a central bank in Japan that has been like the little boy with his finger in the dike. Like basically they are scared of their own shadow. And although they're out of deflation, they're still operating monetary policy with negative real short-term interest rates and an incredibly stupidly cheap yen. Like the yen, now we've gone from 150 to like 143. It should be any valuation measure, any purchasing power parity measure would put the yen down at 120. It's 143. So I think that something's happening in Japan. Yields are backing up in Japan. And I do believe there's going to be a move afoot to strengthen the yen as part of any deal with Donald Trump. And it's stupid cheap anyways. And so the risk is that you're going to find Japanese institutions, and they're the biggest holders. They are the biggest holders of U.S. Treasuries. They're the biggest holders of bonds generally globally, that they are going to be repatriating their capital to the U.S. market. And what does that mean? That means the end of the yen carry trade, which has produced tremendous leverage support for the risk-on assets that people in America and Canada have made gobs of money on. That is the elephant in the room. That's the elephant in the room. Now, we haven't even talked much about trade and tariffs. I imagine that we will between now and the time that we finish today. But I'll just say that the elephant in the room is probably not the US. It's probably not China. It's probably Japan. And the repatriation of capital to Japan is going to have global financial market ramifications.
Okay, obviously I have to pull on that thread a little bit. And so you talked about the yen carry trade. This unwound a little bit in August, effectively in an arbitrage trade. You can borrow in Japan at cheap rates, invest that capital elsewhere. Whatever the spread is what you keep. That's your margin. That trade works as long as rates are very low in Japan. And as soon as they aren't, that trade begins to unwind. Did I capture that correctly? And could you elaborate, please, on why you think Japan is the biggest elephant in the room right now? And
I don't know. It's only the biggest elephant in the room because it's not being discussed.
Okay.
You know, you started off on this show. We're talking about fiscal policy. Most of the time, I start off a podcast or webcast. It's all about Trump, tariffs, and trade. But this is something else that could upend the apple cart for the risk on trade, because so much of the reason why credit spreads are so tight and why valuations in the equity market are so high is because of this carry trade out of Japan, the ability to fund your investments here at home with a cheap currency and low interest rates. Well, all of a sudden, the Japanese yen will not be as cheap. And rates there, not the BOJ, but bond deals have already backed up. The bond market's already telling the Bank of Japan, you screwed up. It's just like the Treasury market told the Fed in 2021, you screw it up, and then the Fed had to follow suit. And then look at what the US dollar did after that. Well, so the bond market, the JGB market is really, and then that's had an impact on global bond markets. That is an exogenous shock, and it's going to influence the leverage that's supported, because when you're talking about hedge funds and you're talking about private equity, private debt, leverage is their oxygen tent. And this is the yen carry trade has been for years a big source of that. And people have taken it for granted. And the fact that we're talking about it now, most of the way through our calls, telling me, we have to bone up on what the implications are. And it means we go risk off. And I know people will say, well, but look what the markets have done in the past. We're 5% away from the highs, blah, 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 blah. Yes, because this is the game of ping pong with the trade. Risk on, risk off, risk on, risk off. Japan has sort of been out of the limelight. But this would be, the stock market is not where it is if we start getting a war of words back between Xi Jinping and Donald Trump. Right now, people are just happy that there's a truce, although we don't know how sustainable it is. And people right now are complacent because they don't really know what's happening in Japan, and they've not been trained or schooled to understand how important that leveraged yen carry trade has been. That is something that if you are long risk right now, this is something if you have no gold exposure right now, because you will want to own a ton of gold. You want to be risk off, not risk on. You want to be in cash. You want to only be in the most defensive parts of the stock market. You will definitely not want to be in leveraged spread product. That much I can tell you. But this is the one area, as you said before, you said, Dave, can you elaborate? Yeah, because most people don't really have a clue as to what it is I'm talking about. But this is a serious risk to the risk on trade from now to the end of the year. One of them. But it's a big one, and one that is not well understood, and one that you will not find on page A1 of the Wall Street Journal.
Sure, until it starts unfolding, no doubt. And so we are risk off. Where do you go? And you mentioned cash and gold. Any other directions you're looking right now, David, as either safe havens or decent hedges?
Yeah, well, I'd say that, look, if I'm a long-only equity manager, and I don't believe in 0 or 100, I think that you should have some equity exposure. The question is where, and I think that I want to be in areas that where there is, call it classic economic terms, price demand inelasticity when it comes to the tariffs, so the areas that will be less hurt. And areas that tend to withstand recessionary pressures, that have dividend growth, dividend yield characteristics, strong payouts. There's parts of the equity market that make sense to me. What would they be? Well, I would say consumer staples, healthcare, utilities. Utilities are bonds and drag. They have the best yields, terrific dividend growth. They're also, of course, a derivative of the AI trade, which is not going away. I'd say if you look at if you have a long term view, if you are basically in your 20s, you could just buy the S&P 500 to just ride it out, or just buy the Mag 7. I'm looking more now, just more tactically, say for getting through the next year. Might be mindful of the beta in the portfolio and the degree of cyclical risk. I would rather be in healthcare, consumer staples. When I say consumer staples, I think that this is going to make a lot of people quite angry, but I like the dividend yield, dividend growth in tobacco. I like food products. Buy the things in the stock market that you need, not what you want. We're going into a down cycle in the economy. We're not going into where we were 12, 24, 36 months ago. Buy what you need, not what you want. Healthcare, consumer staples, utilities. I would say that aerospace defense, we have been long of. That has been a home run. There is not a country in the world that is not increasing its military expenditures. Again, this makes people upset. But then again, if we didn't have military and defense, we wouldn't have won World War II. So I know there's a lot of bleeding hearts out there that say you like aerospace defense stocks. Yeah, well, I'm in the business of trying to make people money and save them money and do it in a prudent way. I'd say that outside of that, you could buy the US at a 21 multiple. I'd rather not in terms of the S&P 500. Or I could buy Europe at a sub 15 multiple. And they have greater growth visibility, I believe. Here we're talking about what sort of fiscal bill, if any, we're going to get out of the United States. We're going to get fiscal restraint. There's no fiscal visibility, at least not right now, but you do have that now in Germany, leading the way for Europe. And Europe has been a better place to be to invest, and especially in when you adjust for the currency. So Europe is on the radar screen. I do actually, because I'm a contrarian by heart, I do like the U.S. Treasury market because everything that I mentioned already, it's become a high yield market. It's become a high yield market. The 5% long bond, 5% long bond. It's interesting to me. You don't want that degree of duration. Well, a 4.5% 10-year note. You're going to say, well, despite all the stuff you're talking about, getting downgraded and global reallocation, so on and so forth. Look, in the land of the blind, the one-eyed man is king. When we're talking about, say, the reversal or partial reversal of the yen carry trade, you'll wish that you were in cash and you wish you were in gold. Because don't forget that the strengthening of the yen is going to drag the DXY down. And there's a near perfect correlation between gold. You could own gold, the gold mining stocks. You can own silver. Maybe you could just own commodities, but I don't really want to be in commodities that are sensitive to the economic cycle. And gold does not have any economic sensitivity. So it's still very bullish on gold and the gold mining stocks, to a lesser extent, silver and the silver mining stocks. But there's a chance that treasuries would get hit too, but you have so much protection. Like, you don't have protection in the equity market, okay? You buy the equity market because of its theoretical unlimited upside, but there's capital risk. There's capital risk in the stock market. The bond market is different. The bond market the treasury market doesn't have capital risk. There's duration risk, there's inflation risk, obviously. Cyclical risk. But treasuries are the only asset class that pay you a guaranteed coupon. And the only asset class where you know in 3, 5, or 10 years what you're going to get paid upon maturity. No other asset class has that certainty of payment characteristics. That's when people say to me all the time about the 60-40. The 60-40 asset mix is gone the way of the dinosaur. I said no. Just because bonds got whacked hard for a couple of years, no, I don't agree with that. Bonds got whacked hard for a variety of reasons. I said there is inflation risk. There's duration risk, 100%. But no other asset class has that particular characteristic of the certainty of payment upon maturity and the guarantee of the coupon. So it's those stable characteristics. It's like almost gold, but different quality and safety characteristics.
Sure.
The reason why bonds had such a rough ride was because back in 2020, 2021, the coupon was 0.5% in the 10-year note. So when you look at convexity and you look at total return in bonds, all you had to do was go up 6 or 7 basis points, and you were in a negative total return situation. You had no coupon protection whatsoever. You have a situation now at 4.5% on the 10-year note, where the yield would have to surge 70 basis points for you to lose money. For you to lose money in the Treasury market, we would have to break above the October 2023 highs. Now, I'm not going to say anything is impossible, but I would put that as highly improbable. What if we go the other way and we rally 70 basis points? What if we go down 70 basis points? Let's draw the distribution curve of total return outcomes. I just said to you, we could go up 70 basis points and you'll be flat total return in the 10-year Treasury note. You won't lose any money. You won't make any money. For all you know, the next 3 months, we're going to have a repeat of what happened in February, March, and April, and we're down another 20% or thereabouts in the S&P. Okay? Like, who knows? Who knows about the stock market? Okay? It's far more speculative in nature, but it's sexy, and you can make a lot of money on the right calls. You're not going to buy bonds to get rich. You're going to buy bonds as a ballast and a stabilizer in your portfolio. What if we go down 70 basis points in the 10-year note? Your total return will be 10%. So we go up 70, I'm flat. Okay, but I got news for you, Jay. We're up 70 basis points for whatever reason, the 10-year note. The S&P isn't sitting near 6,000, okay? It's going to be a lot lower than that if you think about what the shock will be to take rates up that much. But up 70, you're flat. Down 70, you make 10%. Okay. You know what? I sort of like that distribution curve outcomes. I sort of like where those two tails are. So I am actually bullish on the 10-year Treasury note.
Interesting.
I think it offers significant value for the risk right now. So I would add that on to my buy list. And I'll tell you, it is the most detested, maligned asset class. The Treasury market, I talk about it today. They call me the skunk at the picnic. Like, you want to talk about Treasuries? You serious? Everybody hates them. There's a huge net speculative short position amongst the hedge funds. People are scared. People are scared. People are scared of the bond market. But I'm not. And actually, when you get scared of the stock market, it's also, and I'll say this as somebody who's some renowned perma-bear, which is total bullshit, but it's a moniker that the media and people like to place on you. But when you get fear in the stock market and disgust, you want to buy the stock market. That level of fear and disgust is in the bond market right now. But you'll never hear anybody say, I got to buy the bond market. Because look, but I watch the sentiment numbers, I watch the market positioning, and I'm watching the yield protection. That's most important because I want to know what my downside is. And I want to know what my upside is. And I will tell you that relationship right now is more alluring in the bond market than it is in the stock market from where we are today.
Interesting. Well, yeah, and you mentioned gold miners 18 months ago. That was an asset class that was fairly detested, definitely 24 months ago, for sure. Today, the best-in-class names are hitting all-time highs, the sort of Newmonts, Agnico Eagles, the Wheaton Precious Metals. So cash gold as sort of tried and tested, treasuries is your contrarian addition to that. And then if you want
aerospace defense.
Yes, you mentioned a bunch of equities, consumer staples, food, tobacco.
So it's not a long list.
Right.
But at this stage of the cycle, with all the uncertainty and all the downside risks to the economy, way more than there are upside risks. Just read the FOMC minutes that came out today, okay? There's always upside potential. There's always downside risks. The downside risks far away the upside potential in the economy right now. And so that's where I'm coming from. When you're getting to that sort of situation, just read the FOMC minutes. I'm telling you right now that as I read the minutes, if the FOMC officials were running a mutual fund, I'm pretty sure they would have that portfolio I just mentioned. Not 100% cash. No, there's no such thing as 0 or 100 in anything. I don't believe in that. I believe in diversification, but I also believe in managing the beta risk and cyclicality in the portfolio has to be monitored at all times. And for anybody on the show that has not changed or rebalanced the portfolio in the past 12, 24, 36 months, I would say to you, get with the times. You cannot take your asset mix and sector representation from 2 and 3 years ago that worked well in that climate and have the same positioning for today's climate. And it means that you cull the portfolio. You don't have as many names. You don't have as many ideas, because when your conviction level goes down, by definition, your buy list should be thinner.
Sure, of course.
Than it was previously. That's the main message.
Yeah. Okay. Look, Dave, I appreciate you coming back on the show today and opening up your perspective. RosenbergResearch.com. I'll pop a link right beneath this video in the show notes, and Econo Guy Rosie on X, definitely worth a follow. But David, what will people find at RosenbergResearch.com? What are you up to? How can people participate if they enjoyed what you had to say today?
Oh, well, look, as you said, you could just Google Rosenberg Research and click, and it'll take you right to our website. And come on for a 1 month free trial, and you can get our tires. You can go to information at rosenbergresearch.com. That'll take you right through to one of my client service representatives. And for anybody that wants to contact me directly, I'm not going to give out my phone number. However, you want to contact me directly, drosenberg@rosenbergresearch.com. And I'd love to hear from you. Drosenberg, all one word, drosenberg@rosenbergresearch.com.
drosenberg@rosenbergresearch.com. Okay, there it is.
I just gave away the goods.
Yeah, get ready.
My phone number is going to cost you, though.
Yeah, that's tier 2 membership. All right, that's smart. Look, I appreciate it, Dave. It's always great chatting with you. Thanks so much for coming on, and I look forward to doing this again, like 6 months down the road.
Sounds good.
To see how this has matured.
Great.
Most investors think they're playing it safe, following mainstream advice, chasing trends, and clinging to the herd mentality. But there is nothing safe about mainstream advice. The smartest investors know that real wins come from thinking independently and spotting opportunities long before the crowd. And that's what we teach at the Commodity University. This is an exclusive membership designed to arm you with the skills from the sharpest minds in the mining investment world. Each of our professionals has a proven track record of finding trends before anyone else. At the Commodity University, you'll gain access to a highly curated and growing catalog of courses covering what you actually need to know to become an informed commodity investor. Every single month, you'll receive a brand new course packed with insights from the best in the business, giving you the edge to stay ahead. If you're tired of following the crowd and ready to invest smarter, think sharper, and understand the mining industry like the professionals, then take the next step and join the Commodity University today.